Thank you. Thanks for the intro, and thank you everybody for hanging around at this late hour today. Yeah, I want to tell you something today about quantitative trading with machine learning. Yeah, machine learning becomes increasingly popular in quantitative finance in the industry, also on our platform. And yeah, that's why I want to give you a little in-depth insights to quantitative finance. Yeah, first of all, let's maybe define what is quantitative finance. So quantitative trading is, generally speaking, the methodical way of trading. So you come up with an algorithm, with a computer program, with a rule that automatically buys and sells the markets. So a simple example would be if gold gained 5% in the last 10 days, then we buy gold. If gold lost 5% in the last 10 days, we sell gold. This is a simple rule that can be tested on all the known data that is available. And you can see how well this rule would have done in the past. So quantitative trading tries to find and exploit recurring patterns in equity or futures prices. Yeah, the big advantage of quantitative trading is, compared to discretionary trading, that it eliminates much of the human error from trading. So even the best trader might have a bad day and might make a different decision on a bad day than on a regular day. Computers always decide the same way. All right, so it's hard to hear. Okay, yeah, thanks. Okay, so what does the quantitative finance industry look like today? Today, the industry is basically in the hands of a couple of large and very successful quantitative hedge funds. Most of them are in New York. So you might have heard already of Renaissance Technologies or D.E. Shaw or Two Sigma or Citadel, just to name a few. So very successful quantitative hedge funds. It's today a $300 billion industry. And on the one side, these big hedge funds, very successful hedge funds, employ scientists to build trading algorithms, to build these computer programs for them. And on the other side, we have high net worth individuals and institutional investors who then invest in the products that are offered by these quantitative hedge funds. So trading algorithms developed by scientists and engineers and high net worth individuals as clients. Yeah, our role, the role of my company, and also why I'm here today, at least for part of the reason why I'm here today, is we want to democratize this industry. So we want to give basically everybody with the right skills access to quantitative finance. So today, only about 10,000 people work as quants in the industry, writing trading algorithms for these big hedge funds all day long. But there are many more people out there who might be great at predicting financial time series. And that's exactly what we try to do with our company. We want to democratize the access to that industry. And it should not be your job or your title or your academic degree, but rather your skills applied on the data that decide about success or failure in the industry. So we want to make algorithmic trading accessible for everyone. So we are the first marketplace. We connect user-generated trading algorithms with capital from institutional investors. So in a nutshell, you write a trading algorithm and we connect it to capital from institutional investors if it performs well. Our business model is straightforward. Institutional investors invest in your algorithm and you get to pocket 10% of the profits of your algorithm. The institutional investor gets to pocket 80% of the profits because they bear all the risk, obviously. So no financial risk from your side. And Quantiacs also pockets 10%. So we charge institutional investors the industry typical 20% of the profits of any trading algorithm, 20%, and split that amount 50-50 between us and the quant who wrote the strategy. So pretty straightforward. All right, but let's get back to quantitative trading and to machine learning for quantitative trading. So quantitative trading is data-driven trading. And that basically means you have a very well-defined process to write a quantitative trading algorithm. So first of all, of course, you need data, machine-readable data that can be processed by a computer. Then the second step would be you need to come up with a model. You need to have a hypothesis of a pattern. So what happens frequently on equity prices, on futures prices? Is there a pattern that can be harnessed, that can be exploited by an algorithm? So you come up with a model. This is the creative part and the fun part of quantitative trading. That model ultimately should give you a prediction. What happens next with the markets? That's of course the goal. We want to predict the future. We want to predict what happens tomorrow or in a week from now at the very same market that we have modeled. Yeah, and then ultimately we use that prediction to trade. Simple as that. All right, the data. You can use all kinds of data for quantitative trading. The most trivial and most straightforward data is, of course, the market data itself. So the time series of the market that you want to trade. Usually, this time series comes with 4 fields. This would be the open, the high, the low, and the close. So 4 data points per session, basically. So the first price, the highest price, the lowest price, and the final price of a trading session. And then usually also volume and other informations on the market. So this is the first and most common type of data that could be used for financial modeling. Then the second, also very popular block of data would be fundamental data. So for example, corporate earnings numbers, price earnings ratios, stuff like that for equities, fundamental data. Also available and also, of course, in a nice format already to work with it quantitatively. Then just recently, in the last couple of years, sentiment data became increasingly popular. So this tries to capture market sentiment, as the name suggests. So you try to find out basically how traders or analysts feel or what opinion they have about a market. And this data can also be, of course, used for quantitative modeling and quantitative predicting. Yeah, and then ultimately we have also news data. This might be the data that is most difficult to handle because it requires some natural language processing usually. So if you, I don't know, have a Bloomberg or Reuters terminal and you try to parse the news, then you need to make sense of the news that you get through the terminal. And this opens up a huge universe of problems, basically. Yeah. But it's a very interesting and then sophisticated way, of course, to trade the markets. And generally speaking, regardless of what kind of data you use for quantitative trading, unfortunately, financial data usually comes with a lot of noise. So this is probably one of the noisiest data that you can encounter for data science. High noise. And typically, financial data comes, of course, in time series. So you usually have a precise value per point in time. Yeah, some economists argue still today that financial data cannot be predicted. I've been in the quant industry, so I have kind of a different idea about that than the economists. But at a first view, this might be a pretty reasonable assumption, because as you can see here, this looks pretty much like a Gaussian distribution. These would be the one-day returns of the future of the S&P 500, so of the largest US stock market index. And this looks pretty much like a Gaussian distribution. So there's, on the first view, you might get the idea, okay, there's nothing much to gain here. We have maybe a slight skew or a positive mean or something like that, but pretty much a Gaussian distribution. But then on the other side, if you take a look at the chart, this would be the S&P 500 since 1990, so 26 years of data. And I dare say this is clearly not a random walk. Yeah, you can see that it has a clear shift over all the 26 years upwards, fortunately, because companies build stuff, they are successful, they create revenue. So eventually this has at least an updrift. And then we can also see, simply from looking at the chart, that the phases where the market loses are usually, have a different shape, let me put it this way, than in the phases when the market goes up. So usually losses happen much faster than gains here in the markets. So this is, I dare say, clearly not a random walk. All right, so the task is to predict these markets. How can we predict a time series? In our case, a financial time series. So usually, we have time and we want to predict one particular index, usually tomorrow or the next week or whatever. What we want to predict is basically what's the price going to be tomorrow or in the next period, whatever period we're looking for. So a very naive approach to that kind of problem would be we simply take the time series as it is and slice it into chunks of, let's say, 1 day returns, for example. This would be the blue square here. And we take the history up to that point as featured, as variables to predict tomorrow's return. Simple like that. So this would be the light blue bar here. So we have a series of price changes, maybe let's say up until today, and we want to use that to predict tomorrow's time change, price change, this dark blue curve here. Yeah, if we do that for a time series, so we simply split the time series into, I don't know, even-sized chunks where always the target variable, the variable we want to explain, would be the next period's return. Then we have a pretty standard problem that can be addressed with a lot of different machine learning methods. So we have here basically a matrix with a lot of features, variables that can be used to predict one particular variable, one column here, the output of tomorrow, so the price change of tomorrow. So this is pretty straightforward and didn't require a lot of thinking. All right. Now let's get maybe to the applied part of this very naive approach. Let's try to build such a model in Matlab with machine learning tools. Let's take a neural network, a very naive neural network, and try to model the price change for tomorrow. So what we're doing here? Basically, I used here some of the embedded functions embedded in our toolbox. We offer two different toolboxes to help you to model predictive or quantitative models for trading. We have one toolbox in Matlab and one in Python. I personally, since I'm a mathematician, I come from a maths background, so I prefer Matlab, but I dare say most of the audience here prefers Python. So the toolboxes have the same functionality in both languages. We support both languages. Simply pick whatever language suits you better. So today I'm working here with Matlab because it's more convenient for me at least. And what I did here is I simply load two markets. I only need the first one for today's demo. I load two markets, free market data from Quantiacs. This would be the S&P 500 future, the E-mini of the S&P 500, and the 10-year note future, so a US government bond. I define the arguments that I want to have. So I want to get the date vector, open, high, low, close, and volume for every point in time. In our case, this is end of day data. So for every day, I would get those 6 values, basically. And then I define, from when on and to what point I want to get the data. So in this case, I want to get all the data that's available after 1999. And then I simply use the load data function that's embedded in our toolbox. You can simply use that to load market data in a matrix and to do whatever you want with it, machine learning or any other thing you want to do with the market data. So and then the only computation I do here is I take the close values, so the settlements of every session, the last values in every session, and subtract yesterday's close from it. So I take a look at what happened in the last 24 hours and I divide that by the close of yesterday. So this would simply give me the % return in the last 24 hours. Very straightforward. I define that as a return. This is the return in % on that market in 24 hours. Okay, and then I define two vectors. The one I call in sample, which is simply a subset of the returns that I've selected or computed here. I take the first 75% of the data to build my model, and I reserve the last 25% of the data to test my model after I'm done building it. This is generally speaking good practice for financial modeling. All right, so this was all the code that is necessary up until this point. And then let's take a look at Matlab and what we can do with this data. Okay, this was basically here the code executed. So all I have here now in my workspace is I do have the data, the raw data, and here two variables. The one would be in sample, the other one is out of sample. These are simply two vectors with the returns of the last 26 years. So I split that up in two chunks of data. Okay, and now I'm going to use the neural network toolbox that Matlab offers here, so very convenient. What we want to do in our first naive approach, we want to predict the time series. So let's here select time series app. Okay, We have a couple of things that we could now try with our time series. We want to do in this very simple demo a nonlinear autoregressive met. So we simply take the time series and we say assume that it has this structure. So the variable we want to predict is simply just a function of the last percent changes. So the percent change of the model is simply a function of the last d percent changes of the same market. There are no external, no other variables that influence the market. We assume we can completely explain and perfectly explain the price change for tomorrow with the last d values of the same time series. All right, so let's do this. We pick this. Okay, our targets. We want to take the in-sample vector, and this is a matrix column. This is simply the vector of our price changes on the S&P 500 in the last 26 years. So what do we want to use for training, for validation, for testing? Yeah, we just go with the defaults here. So training on 70% of the data appears to be reasonable, why not? And testing it on 15% also, why not? Let's go for this. So as you can see, very convenient here in Matlab. And this is the place where I would define the network architecture. So I have here two parameters, basically. The first parameter is the number of hidden neurons. Think of it as complexity of your network. So how much degrees of freedom do you want to grant your model in this case? And then the number of delays. So in this first step, or my first chart here on the data is that I simply take 2 days, the last 2 days, and try to predict with it tomorrow. Let's see what happens with a complexity of 10 hidden neurons. Okay. Then here we can select the training algorithm. So we have a couple of choices here. Let's go with the second one. This takes usually more time, but can be a good result and a good generalization, especially for noisy data sets, which is good. And let's train this guy. This should not take too long, since the model is very straightforward. Okay, let's give it a little time. Good practice, generally speaking, for building quantitative models, regardless of if you use machine learning methods or if you do something else with the data. It's always good practice to reserve some of the data for an out-of-sample test in the end. You will see, and this is also one of the takeaways of today's session, I can tell you right now already, that most of the models that you come up with fail on an out-of-sample test. And this does not necessarily mean that you did something wrong. This is part of the game of quantitative finance. Yeah? You can have the best idea, the best model. Even some Nobel laureates had great models, long-term capital, for example. Model everything right, and then eventually fail out of sample. This is a very good test that you should always do, because this is the closest you get to real trading. So if you reserve a chunk of the data at the end that you do not look at, you don't use it for modeling, then you can test it on out-of-sample data, and this is the closest you'll get to the performance of your model on live data. Okay, so now let's take a look what our algo found here in this case. We have here an R, which denotes the correlation of our outputs and the targets. So we have an R here of, at least almost 30%. So within a training set, we were able to explain 30%, or we have a correlation of 30% of our targets and the outputs of our model. This is already okay-ish to some extent. But then here we see already where it fails. So at the testing set, this correlation drops to only 1%, so almost nothing. So this already fails on the test set of the very same data chunk. So this is not even an out-of-sample test yet that we have performed. So as you can see, this model will probably have no predictive quality at all on real financial data. Okay, let's take a look at the responses here. Let's maybe find out why that is. Okay, again, Matlab here offers very convenient plots, but you can do the same thing in Python or in R, so this is really, there's no reason to prefer Matlab unless you're more comfortable with it. Okay, as you can see here, so this would be a graphical representation of what has happened. So the yellow lines, these are the errors. The small blue dots on top of here are the training targets, or think of it as what the market really did within 24 hours. And the blue cross would be the trading output, so what our model predicted that the market would do. And as you can see, the errors or the targets are far away from whatever our model predicted here. And another maybe interesting takeaway at this point already is that our model degenerates pretty much to a trivial estimation. So as you can see here, the model usually predicts a change for tomorrow that is very close to zero, much closer to zero than we have seen in the first histogram of the results. So it degenerates a little here to a trivial estimation. Okay, now as a rookie data scientist that we pretend to be here today, what's the next best thing we could do? We could, of course, increase the complexity of our model. We say, okay, it's impossible to explain tomorrow's price change with simply what happened yesterday and the day before yesterday. So let's give our model a little more data. Let's say we want to give our model 30 days of data, for example, instead of only 2. And that we don't need to wait for that again. I did that already. Train again. I want to show you the screen here. Okay, this is 10.2. This is what we just had. Let's close this guy. All right, here's the other guy. So we do the same thing again. This time with more complexity. Here we are. Okay. So we have selected here, okay, not 30, but 20. We increased the complexity of our model. We did basically the same thing. Yeah? We just said, okay, it's impossible with 2 days. Let's give it 20 days. Or we could, of course, give it 200 and whatever. And then at the same time, we increased the number of hidden neurons. So we also give the model more degrees of freedom to find a good fit for the next day. All right, let's do the same thing again. As you can see, the structure of the net is still the same. So there are no other exogenous variables. All right, what can we see here? So this is the result. We take a look at the responses as well. Okay, this now looks a little more convincing, even though if the number is less. So we have here a correlation of our model, interestingly, to only 12% with the returns, with the targets of our optimization. And the test set is slightly better than what we had in the last, but it's still down to 4.5%. So this is still not satisfying or satisfactory. Let's take a look at the response plot here and if we can see some change that happened with this new model here. Yeah, so what we can see here already, at least a bit, is that our model now is a little more away from zero, but still very close to zero. Yeah? So even with a look back of 20 days, this still degenerates to a very trivial solution, even though in some phases our net already makes a little more or bolder predictions than it did before. Okay, so the important thing is, what can we learn from that result? So what is the takeaway of this? Yeah, we did something that is very simple, very trivial, so to say. So our first takeaway might be we need a little more than that. Yeah? We actually need to build a model. We need to come up with a hypothesis. So the first takeaway might be, don't think of machine learning as a black box that does the modeling work for you. Think of it as an optimizer. So you cannot simply take the data and throw it into a machine learning method of your choice and expect it to come up with a cutting-edge model for quantitative trading. The data is much too noisy for that. So there's much too less information in the data that the machine would find it. Then the second takeaway is, yeah, machine learning will always find patterns, even if there are none. So they will tell you that the more parameters you use, the more degrees of freedom you use, the easier it is to fit a known data set. So the more complexity you allow for, the better your fit will be on historical data. So this is here an example. This is just a visualization. If I got 11 data points, I can fit them perfectly with a polynomial of degree 10. This is trivial. Yeah, I can retell the past perfectly, but the predictive quality of this model is inexistent, basically. So a much better approach in this case to estimate these dots here, or these observations, would be a regression, a linear regression. So keeping it simple is actually good for building a model. All right, the second takeaway, pre-process the data. Again, financial data is very noisy. That means if you throw it into a neural net, you usually don't get a good result if you throw it into a neural net as it is. So what you want to do is you want to filter it, to smooth it, and to extract features from it, meaningful features. Features that are maybe more meaningful than the return of yesterday for predicting today's return. So how could we do that? We could, for example, simply take the data and run an SMA over it, a standard moving average, an exponential moving average. We could use some other technical indicators or filtering methods to try to smooth away some of the noise of this chart, of this financial data. Yeah? So pre-process it and feed this as a feature in your neural network. Then from the very same time series, you can extract different kinds of information. So not necessarily only direction, like we did here. So we looked at the percent changes and said this is a directional indicator, basically. And we only use directional indicators to predict the direction of tomorrow. But you can also extract some information like volatility. How volatile is the market? And this is somewhat, even though it comes from the same time series, this can be interpreted sometimes as somewhat orthogonal to the other information, so to the directional information. So it's always good to feed your net with, or your support vector machine or whatever. I'm not saying here that neural nets are the best tool to predict financial time series. So feed your model with real features. Derive those features from the market data. So this is actually the modeling work that needs to be done. Yeah, and then also, of course, normalization is an issue. So in financial data, let's just think of two different stocks. They're both priced at $100 at the moment. One of them has a volatility, or a movement per day, an average movement per day of 5%. The other one has an average movement per day of 1%. So clearly, the first one is more risky than the other. This might also be something that you want to consider in your model, especially if volatility is one of the indicators, of the target indicators that you train your net for, then it often happens that your solution converges to the least volatile market, depending on the loss function that you have. So this is something that you might want to consider. So pre-process the data, normalize it, and then extract features from it. So the features can be much better than the features that we have used now in our first simple demo here. The third takeaway, and this is also a very important takeaway, what we tried here was we tried to simply predict the price change of tomorrow. This might not be enough. Even if our model is very good, simply the price change of tomorrow, having a weak estimator for that might not be enough. Because in reality, whenever you trade, you encounter costs. Trading comes with costs. We summarize that on Quantiacs as slippage. In reality, it's slippage and commission. So usually your broker wants to be paid. Usually if you buy a market, you have to buy it at the wrong side of the spread for you. So if you think of the order book, in the middle there is nothing, then this is exactly the best bid and best ask. And usually you have to cross the spread. So you have to, usually you get, I don't know, depending on the stock or what, or future, at least a 5-cent punishment, so to say, or a 5-cent worse price than you actually estimate you would get. And then, of course, the larger your lot size is, the more market impact your order has, and so on. So we summarize this effect, and we call it slippage. And slippage is obviously a function of the volatility of the market. So the more volatile a market is, volatility would be price change per unit of time. The more volatile a market is, the higher is usually the slippage that you encounter. Our model here is a very simple model. I'm not saying that this is the best ever, so there are many more sophisticated models than this, but we take simply 5% of the daily range, and the daily range is for us simply high minus low. So this is where the volatility of the session would come into the play. So to get back on our define a YT, define a variable that you want to estimate. Even if you have a model that predicts you tomorrow's price change, that might not be enough. Let's assume a situation. You predict today that the markets, that you want to be long in the market. Yeah, you predict rising prices for today, so for tomorrow's session. So you buy the stock. All right. Then your model tomorrow tells you to sell the stock again. So you have to basically do a 200% flip of your position from 100% long to 100% short. This means that you encounter a lot of slippage every day, and your model might simply not be good enough to overcompensate for that slippage. Even if you're right, so even it's not necessary that the percent change in 24 hours between close and close is actually higher than the slippage, and the slippage always works against you, even if your prediction is right. So even if tomorrow's close is higher than today's close, that delta might be lower than slippage. So define a target function that is a little more robust. I can only advise you to maybe not look 1 day or try to predict a 1 day return, but maybe a 10-day return or a 30-day return. So think in longer term. And the last and maybe most important takeaway here is that a different objective function from the standard or classical objective functions that are used in machine learning can give you much better results than the normal loss function. So typically, a machine learning method tries to minimize a loss, so basically the error between prediction and observation. And this is something that we have seen here. This degenerates, in some cases, to the trivial estimation, simply because data is very noisy, and with 0 you're always about right. And basically the loss function, this is often actually a minimum of the loss function. Yeah? So for financial time series, you need to dig a little deeper. And in order to avoid that degeneration to the trivial estimation, you might want to introduce another objective function. And I can only recommend one of the objective functions that are out there is the Sharpe Ratio. And the Sharpe Ratio is not only an objective function, but it is also a performance number that's very important in finance. And this is the only mathematical slide today. This is the definition of the Sharpe Ratio. So this is basically in finance the performance, or a very central performance number that you use to compare the performance of different funds or assets or whatever. So the Sharpe Ratio is a very, very commonly known and very commonly used number in quant finance and in finance in general. So how is it derived? We take again the percent returns here. So this would be E would denote the equity curve or the return curve of your portfolio. So we build the first momenta of this curve and divide it by yesterday's values. We again get the percent returns, and then we simply annualize that and define a yearly volatility. This is simply a factor, the square root of 252. We only use that to annualize the daily returns. So we have here returns on a daily scale, so daily market data. And on average, we have 252 trading days per year. So that's why we multiply the number with the square root of 252 and take the standard deviation of the returns and define that as volatility. And then we have, we compute of the same returns and index and compute the daily return. Think of this as the average daily performance of a trading system. And then the Sharpe Ratio is nothing else, and then of course we annualize it again here. So this is what we do here. Return daily would be 1.0, hopefully 1.0 if it's positive, 0 something, and we take that to power 252 to annualize it again, and we get and subtract 1. This is the return of your trading strategy or of a trading strategy per year. And the Sharpe Ratio is then simply the quotient between the yearly return and the yearly volatility. And this is a very, again, a very central performance number in finance. You're not so much interested in the return that you make per year. Of course, you're interested in the return as well. But you're interested in the return with respect to the risk it took you to achieve said return. So simply saying, I gained 100% in the markets. That's a strong and bold statement, of course. Yeah. But if I had to risk my basically 1,000% of my portfolio value, then this is not a good trade. This is a Sharpe Ratio of 0.1. If I gained 100% and I only had to risk 10% of my, or I had 10% volatility, then this is a very good Sharpe ratio. It's a Sharpe ratio of 10, something that's not achievable, I dare say. We'll see. All right, so this is the Sharpe ratio. Can be used to measure the performance or the success of a trading strategy, and is also a pretty decent and pretty good objective function for machine learning. All right, now you might wonder, can it even work at all? So our first 2 attempts failed miserably, and I only told you what we did wrong. So now the question is, can it work? Yeah? And the answer to that question is yes, it can. This is not my trading system, but we're very proud and happy to have this trading strategy, obviously. This was written by Genia. He's a theoretical physicist from Caltech and one of our most successful quants. He won our Q3 competition with his system here, hover cars, based on a machine learning method, just FYI. And we traded since a couple of months now with $1 million in futures, and we're pretty happy to trade it. So it has a live Sharpe ratio of 2 at the moment. So yes, it can work. By the way, this is not investment advice here. This is just FYI. This is just what's possible with the data, okay? Nobody can invest in this. All right. Yes. All right. So let's close this session, or almost close this session, with good practice and pitfalls for quantitative trading. The natural enemy of quantitative trading is overfitting. It's easy to retell the known past if you allow for sufficient degrees of freedom. So you want to keep it simple. You want to feed your model with a few and pretty good features, actually. Keep your model simple. Don't allow for too many degrees of freedom. You will fail on live data, usually, if you overfit. Then stability is the second issue. You might want to check how your model reacts if you change some of its parameters by, say, 10%. Does it give you still a same or similar result, or does it fail completely? This would be not a very good indicator if it fails completely or if it does something completely different. Then the third thing is perform cross-validation of your model. So what we here did was very simple. We just took what Matlab suggested. So we have a training set and we have a test set. You can be much more scientific or much more cross-validate your results. You can use one set to train, test it on the second. You can do it the other way around, and so on. You can do this not with only 2 sets, but maybe with 3, 4, 5, and so on. So cross-validation is very important. Save some of the data for an out-of-sample test. This is also very important. This is the closest you can get to live trading, out-of-sample testing. And then ultimately avoid market selection bias. This is also a very common mistake, especially for stock trading. So usually people think they are creative or good if they pick the right stock where everybody knows that this stock won in retrospect. Yeah, of course I would have picked Apple in 1990. Who wouldn't have? Yeah? So avoid market selection bias. Usually if there is no quantitative reason to pick a particular market, don't pick it. It's much easier with futures than with stocks. All right, to sum it up, we provide you with free market data of the end of day data at the moment, 49 of the most liquid US and European futures. We prefer to work with futures, so do our investors, because futures offer a huge universe of diverse and uncorrelated markets that are highly liquid markets. Yeah? So the trading strategies that work with futures are highly scalable. We can manage with hover cars 300 million. That's a nice number. That's usually not possible with equity trading strategies. So futures offer a very diverse instrument. That's why we focus on that. If you prefer to work with stocks, however, we also have the S&P 500 stocks, I think back until 2000 or so. So our market data is free, so is our software. You can simply visit our website and download it, download our toolbox to perform back tests if you want to come up with your own quantitative trading strategy. Yeah, here's a brief overview of our futures data. As you can see, a lot of agricultural futures, bonds, currencies, indices and precious metals and other stuff. Yeah, how can you get the market data? You can simply use the functions from our toolboxes to be precise, so either Matlab or Python. The load data function would give you the market data on your computer. Or you can simply use that link down here to download the market data. We update it daily. You can simply visit our website site and download the market data with your own scripts and use it for whatever you want. Yeah, we also, maybe that's interesting for you, we frequently host competitions, just like the one that Genya has won with this algorithm, where the first prizes of these competitions are guaranteed investments in the best performing algorithms, usually of 1,750,000 and 500K in futures. Our Q6 will be announced, our next competition will be announced in the next couple of days, and you have time to submit a trading system until June 30, 2016. And the winners, as usual, get to pocket 10% of their algorithm's profits. So we run the algorithms, we validate them 3 months on live data, and after these 3 months, we allocate investments to the algorithms, and you get to pocket 10% of your algorithm's profits, as usual, on our platform. This was pretty much it. I say thank you for your attention. And if you want to dig a little deeper in algorithmic trading with machine learning or not machine learning, then I can recommend the resources on our website. We have a reading list with a lot of good papers also about machine learning. And then, of course, also video tutorials. I can also recommend one video tutorial of Genya, the guy who wrote that system, gave a talk for the machine learning meetup here in the Bay Area. And yeah, talks a little about his tricks for quantitative trading. All right, this was it. Thanks a lot. And shoot if you have questions. Any questions? Yes?
Communication, if you submit, who owns the final IP?
Okay. Who owns the IP if you submit an algorithm? The quant owns the IP and grants us the right to market it. Otherwise, our marketplace would be useless. So we are here to connect your algorithm to capital from institutional investors. That means you upload it to our machinery. Yeah, you upload the source code. You've got to live with that, so to say, but you get to keep the intellectual property of your algorithm. So we're not allowed to look at it, to redistribute it, to publish it, or whatever. So it remains your intellectual property. Yes?
There's a popular notion that algorithmic trading over the years greatly impacts the performance of the market, volatility and whatnot. Is that true? Is that noticeable? Is that true in your opinion? And if yes, do you take that into account? So does model take its own trading into account?
Okay. Does algorithmic trading influence the markets a lot? And do the models take that into account already? Is that correct? Okay. To be honest, yes, it does. So high frequency trading, for example, is also usually considered to be algorithmic trading. And this influences the markets a lot. But not necessarily in a negative way. So high frequency traders provide liquidity. And liquidity is a very nice property of a market. But of course, every participant in the market influences them. Could be a large discretionary fund that influences the market. So if Bridgewater does something, you better do the same thing. You want to do the same thing. So yes, algorithmic trading influences the markets like any other trading style as well. And depending on the style of algorithmic trading, so high frequency trading, maybe even more than other styles. Yes, that's correct. Okay, one more question, if there is one. Yes?
Do you have like so people just submit their trading strategies, right? Do you have like a consistent API that they're supposed to work towards?
People submit the trading strategy, and do we have a consistent API that evaluates it? Is that?
Yeah, like a consistent buy and sell API, like a consistent positions monitor.
Okay.
So that you can verify.
Yes, absolutely. Okay, if we do have a consistent API, position monitor or buy and sell API that basically tracks the performance of the algorithm and can be used for trading. Yes, we do have that, but that's you don't need to worry about that as a quant, so that you're left alone with the hard part, coming up with the model. Once you did that, you can upload it to our website, and we take care of the live trading operation. We also build up the live track record of your algorithm, because this is, of course, what investors ultimately want to see, how well your model performs on live data. So they're not that interested in the backtest alone, but also in how well your model performs on live data. And this is what we show them. So as soon as we get a system on our platform, we start building up its track record. So every day as new market data arrives, we evaluate it. And then if it gets an investment, we also trade it on behalf of the investor. So also the investor, of course, never gets to see the source code. It's a black box to them too. All right, one last question.
Secret information, by your opinion, what kind of algorithms work better, like neural networks or?
Okay, what kind of algorithm work better, or what kind of machine learning method works better for algorithmic trading? Frankly, if you use it wisely, any of them can work. That's really it. So I cannot recommend you support vector machines work and neural networks don't. So that's simply not true. It depends on how you use them. The same is true for all the filters that I've mentioned. So the SMAs and then the RSI and maybe the standard deviation of the returns and stuff like that. It always depends on how you use them for your specific model. So from what we hear from our quants, neural nets are pretty popular and support vector machines are pretty popular. But I would not recommend you the one over the other. All right. Thanks so much. If you have questions, I'll be hanging out for quite a while and just shoot them. Thanks.